Hi traders, Nick here. Welcome to this Trade Secret tutorial on results and ex-dividend days for stocks traders. So every year on a given day, listed companies announce their results. It's part of their requirement for being a listed company. These results are either above, below, or in line with the market expectations, and consequently, depending on those results, it will affect the share price. Most company results are announced outside of market hours. That's either after the market closed on a given day or an hour or so before the market is due to open. They're not often released during the day, or at least not formal results anyway. Very unexpected results can cause price gapping, and price gapping is a problem, but it can also be good as well as bad. But as far as we're concerned, we're risk managers. We're always thinking about the downside potential, and bad gapping can be bad indeed. If price gaps through an entry price, or more importantly stop loss, then this can be a major problem. You have to remember, of course, for your orders to be triggered, price needs to move through that price. If it gaps or jumps that price, then it can't trigger, and brokers have to do the best they can at the best price, and that's where the problems can arise. Many companies release interim, half-yearly, or even quarterly results. It depends on the size of the company and their listing constraints, but most companies will at least have a full year and an interim, and the bigger ones, notably the banks, tend to have to do it every quarter. So, avoid entering trades near results days, as clearly news is unwanted uncertainty to any potential trade. All trading carries a measure of risk and uncertainty, so we don't want to add to that, and trading when news is not there is the best way to help mitigate that. Ex-dividend days occur when shareholder rights to receive profit-related dividends expire. So on a given day, someone says, right, shareholders are no longer entitled to the dividend we've just announced, and as a result of that, the value of those shares falls, because the value of shares is as much about future earnings as it is about the money that they're going to receive on the back of company profits for that last year. So it makes sense that as soon as they're no longer entitled to that profit in the form of dividends, then price does fall a bit, because obviously we don't know what the next year's dividend is going to be. So let's have a look at gapping then, which is really what this presentation is all about. So in our diagrammatic form here, we've got a reasonable uptrend of sorts here. We know either through your charting package or through the website or whatever means you've found out that we have scheduled company news due out tomorrow. So that could be full year results, it could be interim results. So we know that we've got news due out tomorrow. If we are already in this trade, then we might draw up our stop loss to, I don't know, 1 point beneath the day low. So if we're in the trade, we might draw up at stops anticipatory. So what happens? Well, the next day price opens significantly lower. So either after the close of the market here or before the market opened here, some news was released to the market. It was not good. Consequently, you've got a big gap down. Now, for those people already in the trade, this stop loss here would not trigger, because price has not moved through it, and your broker, the best, let's say best case scenario, it opens at the high of the day. That is the best point your broker is going to be able to get you out of this trade. Obviously, if it opened right down the bottom of the bar, well, then that's the best price that your broker is going to get you out. Your broker will get you out knowing you're on the wrong side of your stop loss. He will get you out as soon as possible. So whenever the market opens, whether it's the top of the day or the bottom of the day, of which obviously you won't know till the end of the day, he will get you out there. So depending on your risk to reward ratio, that gap could be nasty for you. Now let's say that you got into this trade down here on this swing low, perhaps you got in on the break of this high bar and your stop loss was under here. Well, in that case, that's not going to be too catastrophic for you. That's going to be your 1% or your 2% loss. But let's say you got into the trade up here and originally your stop loss was here, and that's the basis for your risk reward. Well, then that's pretty nasty. That's a 2 or 3% loss through there. So that's a reasonably extreme version of how a stop loss or gapping through your stop loss can be not good. So let's have a look at some examples then. So this is SAB Miller. We can see that we had a reasonable uptrend, so you'd be understandably long in this trade up until this point. news comes along, boof, gaps down. That would be not good for anyone long in that trade. Let's have a look at Man Group. So Man Group, the primary direction trend is down, so we'd be looking for short positions here. So if we were short down here in the trade and the results are announced and we gap up, ooh, that's not going to look good either. So, you know, at that particular point, yeah, we could be 1% or 2% down. This is Scottish or Southern. Now this is an example of where gapping can work for you, but obviously you don't know which way the gap's going to go. The trend is down, so you would be short, that you wouldn't be trading against the trend. We're already short here, the news comes out and we open even lower, so that's a nice jump move in the direction of the trend, so that would have helped people in the trade. But the point is we don't know which way that's going to gap. It could have just as easily gone the other way if Scottish and Southern had an unusually good year and no one knew about it until the results came out. So gapping can work both ways. And this is an example of the ex-dividend situation. So traders, bit of a recent uptrend of late there, but on the day that the ex-dividend day is declared, price right down. Okay, it carries on afterwards, but on that particular day, and it depends on how you got into this trade, where you got into your trade, where your stop losses were, and your risk to reward, etc., etc. But it's good to note that prices do tend to fall on ex-dividend days, and you should bear that in mind. So, summary. News adds uncertainty to our trading. We rarely want to trade where news is. It adds a level of confusion and uncertainty to trading that we don't really need or want. Avoid entering positions on or near company results days. That's a no-brainer. You know, just don't go near it. There might be a very tempting setup, but you've got to be disciplined and just wait for the news to pass, then look for your entry. If you're in a trade when news approaches, then you should take precautionary measures. It is the right thing to do. Share scope or a company website, or I think even the London Stock Exchange, if you're using that particular bourse, will tell you when scheduled results days are, and you can therefore anticipate those. I quite like share scope because there is a setting where you can get it to tell you or flag to you when result dates are coming to stop you getting into trades you otherwise wouldn't have done. Company news can, of course, be released at any time without warning. That is the nature of the market. But, you know, let's just try and avoid the ones that we know about. Let's do what we can to mitigate our risk at least. Ex-dividend days often see price falls. That is usually the case. Doesn't always happen, but more often than not it does tend to fall. And gapping, specifically large gapping, it's good to remember that gapping is rare, and particularly large gapping, and it can also happen to your benefit, depending obviously whether you're long or short. It's not all bad, but this is about risk management, this business, and yes, it's nice to get lucky on a positive gap for our trade, but by and large I do try and avoid any situation which could result in a gap, because the tears are always worse than the cheers.